Reliance Industries shares jumped over 3% on March 27 after Goldman Sachs reiterated a buy rating on Reliance Industries Limited, with as much as a 54% upside by FY26 in its bull case, citing favorable risk-reward dynamics, value unlocking from its Disney joint venture, and enhanced return on capital investments. With the capex cycle in two capital-intensive businesses, Reliance Retail and Jio Telecom, reaching its peak, Reliance will now start seeing improvements in its overall performance, said Goldman Sachs analysts. The brokerage raised the target price on the Reliance stock to 4,495 rupees in the bull case and 3,400 rupees in the base case, implying a 17 to 50% return from the previous closing price. Reliance Industries shares tend to outperform the Indian market under two conditions: expanding returns and valuation discovery through stake sales in newer businesses, the brokerage said. Analysts at Goldman Sachs believe that RIL's consolidated returns are at an inflection point in FY24, and its cash return on cash invested will expand by nearly 270 basis points to 12% in FY27, which will be the highest since 2011. The brokerage noted that RIL is coming out of a series of long and intensive capex cycles. Reliance Industries has invested over $125 billion in capex over the last decade, mostly in hydrocarbon and telecom, which are more capex intensive and have a longer gestation period of over 5 years. On a consolidated basis, analysts at Goldman Sachs expect Reliance free cash flow, which has largely remained negative due to the elevated capex, to turn positive in FY25 with capex likely peaking out, while EBITDA may expand by 20% on year, led by a telecom tariff hike, higher retail same-store sales growth and a recovery in chemical margins. The continued shift of consumers to smartphones, robust growth in fixed broadband, recovery in petrochemical margins, driven by global demand and lower feedstock prices, along with sustained strength in diesel cracks due to limited global spare capacity, coupled with operational expenditure reduction, will also support high double-digit EBITDA growth. So far this year, Reliance shares have rallied 14%, outperforming the benchmark Nifty 50, which has risen a little over 1% during this period.